Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Today's guest is one of the best investors you've never heard of. Cristiano Souza has quietly delivered annual returns in the high teens to low 20s over a 30-year career. He rarely gives interviews and has only ever given one in English and one in his native Portuguese before today, so I'm grateful he's agreed to this one. Cristiano grew up in Brazil, studied economics at university in Rio de Janeiro, and joined the renowned Brazilian investment firm Dynamo at just 19 years of age. He spent nearly 3 decades there, becoming a senior partner and co-managing Dynamo Cougar, which compounded at 24% annually. In 2015, he launched Dynamo's UK office, eventually leading to a spin-out, Zeno Equity Partners, where he now serves as a CEO. Based in London, Zeno focuses on concentrated long-only investments across the Americas and Europe, and since the spin-off, the fund has returned 19% a year. Cristiano looks for dominant businesses with strong moats, smart incentives, and resilient cultures. Above all, he is obsessed with minimizing permanent capital loss within his fund. So without further ado, Cristiano, welcome.
Thank you. Thank you, James. Thanks for having me.
My pleasure. So you traded Rio's beaches and colourful carnival for an umbrella and grey skies in London. Be honest, what were you thinking?
I get asked that question a lot. The truth is, both cities have incredible qualities that I love, and they're a part of my personality. So I think Rio has, obviously, it's where I spent the vast majority of my life. It's where I grew up. And it's a very special place. But London, over the past 10 years since I got here, has grown to be a very, very special place for me as well. It's where I raised my kids. It's a great city, vibrant, intellectually challenging. So I do well with both worlds.
So, I mean, of all the financial centres, why did you choose London? Why not New York or Singapore?
First of all, because to be very honest, I don't really like New York that much. I find it exhausting a bit. Second of all, I think London sits right in the middle of the markets that I am interested in. To be perfectly honest, Asia is a very distant, very foreign culture and place to me. I don't think I would ever be able to develop an edge investing there. So it was never really a place that I considered going to. Maybe if I was at 19 when I started Dynamo, if I had moved to Singapore then that could make sense. I'm too old to make such a big change, where I was too old 10 years ago, imagine now. And I just love London. It's a great city, and it's a place where all companies stop by. So I get great access, meet a lot of interesting people. So it just felt right.
That's certainly a great hub and very easy to reach most places. Okay, that answers the question. Your compound annual returns in the high teens to low 20% range are staggering and up there with the very best investors. Yet you shy away from claiming the credit. Instead, very humbly, you credit your team and a culture of humility and consensus. So to get a feel of the office culture, how do you cultivate consensus-driven decision-making while maintaining humility at Zeno?
I think it's not so much a consensus-driven approach. I in Zeno, differently from Dynamo, where I spent 30 years. In Zeno, I am the ultimate decision maker. But what I very much try to do, which is what I learned in Dynamo, is to foster a culture where everything that you say can and will be challenged, no matter who you are. And you want to foster an environment where people feel like they can say absolutely anything to anybody, provided they're respectful and they're doing it for the right reasons. And I found it incredibly helpful to work in an environment like this, because it helps me keep my own biases in check. We all have biases as individuals, and we can either let them rule us, or we can try to use them to our advantage. And having different perspectives and different distillations of the world has always helped me tremendously when I'm trying to make a decision.
That makes sense. Yeah. So you've done away with any kind of hierarchy. Everybody's there. Everyone can introduce constructive challenge, which is the way it ought to be. How large is the team?
Team is we're a total of 8 people.
Okay.
5 people in the investment team. And 3 people in sort of back office, middle office operations.
Okay. Something you once said really stuck with me. You don't see yourself as a professional investor, just someone who chose to put most of his wealth into outstanding companies. And you added that it's been a privilege to earn the trust of others who have asked you to invest their money alongside yours. So as I understand it, your team also invests their own money into the fund. And I'm really interested in how invested your team is in the fund. Is it most of their net worth? And when someone new joins your team, is it a requirement that they make a sizable investment? How does that work?
it is a very liberal environment in the sense that everybody does what they want to do. I have 80, 90% of my net worth invested in the fund. And that's where it's been all my life. It's always been like this. Uh, Different people will have different tolerances. What I hope to achieve over time, and obviously people at different stages in life will have different needs and different objectives. But the idea is that everyone has a predominant part of their net worth invested in the fund. And that in time, that becomes a large enough pool of capital where this becomes the growth of this net worth becomes the main source of income for them. So in my case, I make a lot more money from the compounding of my wealth invested in the fund than from fees that I may collect from the fund that I manage for other people. And ideally, we would have everybody here thinking that way. So that's sort of how I try to do it. But I don't force anyone to do anything. And that also ends up becoming a good gauge for whether the people that I have working with me are like-minded and will be my partners for a long time, because I can observe their behavior over long periods of time.
Yeah. No, listen, I think that's the way it should be. If you're looking after other people's money, but you're not prepared to put your own money into the fund, it's like they say, a chef should be prepared to eat his own cooking.
Yeah.
So yeah, it makes a lot of sense. So you just said that you have 80 to 90% of your own net worth in the fund. Just out of curiosity, why was it that you decided to manage your own money and not kind of place it with other fund managers before you got into this game? What was it
well, I got into this game before I had money, so I didn't have an option to give my money to someone else.
Okay.
And I chose to do this when I was 19, as you had mentioned before, and it's what I like to do, and I like to be able to grow and take care of my own wealth. So it never really occurred to me to invest with others.
Makes sense. So Brazil's volatile economy taught you a lot about resilience and risk. How do those lessons carry over to investing in more stable markets like North America and Europe?
Well, I don't know if they're that stable, right? Look, I think that when we started in Brazil in the early 90s, we had no idea what was going to happen to the economy. And I don't think anyone really does. The world is an adaptive, complex system, so predictability is close to zero. And what we realized early on in our careers is that the only way to protect yourself from an inherently volatile world and highly unpredictable is to invest in assets that are adaptable themselves. And the most adaptable asset that exists are equities. And the ability to adapt combined with resiliency, which you'll find in the equities of the best companies, it gives you the best chance to protect yourself from pretty much anything that is thrown at them. So I kind of got that burned into my brain in the early 90s in Brazil, because you never knew what was going to happen. And we had real interest rates of 40%. We had inflation of 20% a month. We had deflation. We had currency devaluations of 80% in 1 year. And the only thing that sort of withstood all that were the profits of these great, super resilient companies.
You're pretty well placed now to manage the turmoil in the markets after the Trump tariffs, right?
I feel like it. Yeah, I've seen much worse, to be very honest.
Fair enough. You've said that long-term resilience trumps short-term outperformance, and it reminds me very much of Howard Marks. He always said, protect the downside and the upside takes care of itself. How do you assess a company's risk profile? I mean, what matters most? Is it cost control, capital allocation, the balance sheet?
What matters most is, I think, first of all, adaptability. So the ability to recognize what's happening in the world and take the necessary steps to preserve your profitability and to preserve the long-term compounding of your business. And that adaptability is itself a function of the ability of the company to build what we call market power. So and there are three things that we are obsessed about when we're looking at companies. And these are the three pillars on which every investment decision that we make rests upon. And they have to coexist in a virtuous cycle, which we call market power, a reinvestment opportunity, and a founder's mindset. So market power is the ability of the business to exert dominance over a certain profit pool. Reinvestment opportunity is the ability of that company to take the high returns on capital that come from that position and reinvest them back in the business so that they can generate compounding. And a founder's mindset is the culture that allows this binomial to sustain itself for a very long time. And what we mean by that is that cultures that are too focused on short-term profit maximization will inevitably sacrifice the long-term value of the business for the sake of the short term. And we look for companies that do the exact opposite when necessary. And we look for people running these companies who are not that worried about what's going to happen to their bonus or their stock option vesting in the next 3 years, but that recognize that the best way for them to build wealth is to compound that dominant position that they find themselves in for a very, very long period of time.
Yeah, so it sounds like the Jeff Bezos model. I mean, it's
Oh, yeah.
not easy to discern people with that mindset from the outset. I mean, he set it out in his 1997 inaugural letter, shareholder letter, and he stated very clearly, you know, this is the way I ride. I steer the ship. I'm in it for the long term. I'm not interested in Wall Street's short-term expectations. And you know, I suppose he set out for investors that if you have a similar mindset, then you know, come along for the ride. And if not, then perhaps you better put your money elsewhere. But it's quite rare for a CEO of an early-stage company, in particular, to lay his cards on the table in that way. So what is it that you look for to see someone who's got the right attributes and the staying power?
There's in 1964. There was a Supreme Court justice in the U.S. Named, I think, Potter Stewart, and this judge was asked how they would describe obscenity, and his answer was, "I don't really know how to describe it, but I'll know it when I see it." And I think that this applies perfectly to this founder's mindset culture. It's extremely hard to describe, but if you've looked at enough instances, you will recognize it when it's there. So Bezos and Amazon is a perfect example. In fact, I'm just finishing our quarterly letter, and in it we are talking about their shareholder letter that was published just a week ago.
It was impressive, wasn't it?
It was exactly what we talk about when we're looking for companies. So if anybody wants to understand what we're looking for, just read that letter and you will find it there.
Yeah, I mean, that's interesting because that letter was written by Andy Jassy rather than
Yep.
Jeff Bezos. But nonetheless, the culture is unchanged despite the change at the top.
It's even more interesting because sorry to interrupt you, but when they publish the annual letter, they always publish the original letter from Bezos together with it. So if you go to ChatGPT and you ask them to highlight aspects of the culture in both letters, ChatGPT will spit out quotes from both letters without really knowing the distinction from one to the other. So that to me is proof that what Bezos built is a truly resilient culture.
It is, and I suppose it also speaks to promotion from within, which is very important. You know, getting other people through the company to understand the culture and then to promote them rather than bringing in outsiders. Okay, I mean, I'd like to return to that topic a little bit later. But for now, you've said that any business can have a great 5-year run during which they crush all expectations, but very few businesses are set up or have the resiliency to thrive when the economic cycle turns against them. And effectively, I think what you were saying is that they get so carried on the wave of success during the good times that when they hit the bad times, they make very poor decisions and they end up destroying value. Is this something you've encountered in the past? I mean, are there any kind of examples you can allude to?
Yeah, many times. I think it's a combination of two things. It's what you said, and the other is that in such a short period of time as 5 years, it's very, very difficult to distinguish luck from skill. So anyone can go on a lucky streak for a few years and have their business make a lot of money. And they may find themselves at any point in that 5-year period having to make decisions that maybe would allow them to perpetuate that position. But invariably, people will choose to continue to try to maximize short-term profits. And usually that's when things turn south, because then the world will turn against them. The lucky streak will go away. And like Buffett likes to say, the tide will come out and we'll see who's swimming naked, right? So there are a number of examples. One that immediately comes to mind in an industry that is a fantastic industry that I think has lots of great attributes. You look at a company like Kering, for example, that owns Gucci. We spent a lot of time trying to underwrite an investment opportunity there, and always having the opportunity to compare it with LVMH and with Hermes. And what we found in Kering is that they had this incredible run from 2014 until 2019. Gucci tripled in size, but clearly the management team there engaged in behavior that was predatory to the long term of the business. They were too focused on maximizing growth in the short term. And eventually the cycle turned, and the cycle of preference from customers changed, and they had overextended the brand in ways that is going to make it very, very hard for them to climb back. So that to me was a very good recent example of a company that had the opportunity to take an incredible run and perpetuate it for a very long time, and they chose instead to maximize short-term profits to the detriment of the value of the business over the long term.
It's interesting you bring up Kering because I've always had an issue with the fashion brand industry. It causes me all sorts of problems from a moral and a kind of philosophical viewpoint. To just kind of explain the way I look at this, you think about this. If I pick up a book in a bookstore and it has the name Charles Dickens on the cover, I know exactly what I'm getting in terms of style and quality. And I'm sure you'd agree it would be entirely wrong for someone else to use his name on their inferior work longer after it died, simply to cash in on his name. Yet that's exactly what happens in the luxury and the fashion industry. I mean, when you buy today Balenciaga or Chanel or Dior, what are you paying for? They're all long dead, and the products now bearing their name are no longer the kind of exquisite haute couture that they used to produce. I mean, a lot of it is mass produced. And you look at what Kering has done. I don't know if you know the story of Balenciaga, but Cristobal Balenciaga was in a league of his own. In fact, I think Chanel and Christian Dior used to look up to him because they could never achieve the kind of heights that he could achieve. And when it came the time for him to kind of hang up his gloves, he was getting old. He had a decision to make. Did he sell the company? What would he do? And what he decided was actually to shutter the business because he knew that there was no one to hand it on to that could keep up the quality of his work and to keep up the reputation and the brand that it created. Which is quite a brave decision because I'm sure the brand was worth quite something. But he let it lapse, and a few years later he died. And one way or another, I'm not sure exactly how it happened, but Kering ultimately acquired the name Balenciaga. And now, they make plastic beach shoes with Balenciaga name on them. And, Cristobal must be turning in his grave. And that just doesn't sit with me. I mean, for me, there's just something dishonest about the whole thing. How do you feel about that? I've never been able to invest in those companies for that particular reason.
Yeah, look, I try not to judge because this is at the end of the day a consumer choice. So no one thinks that Cristobal is there manufacturing those things. No one thinks that Christian Dior has come back from the grave and is designing those handbags. Everybody knows, but those brands, if well taken care of, if working on their legitimacy as faithful to the origins, they will mean something for people, and there's an emotional connection to those brands that goes well beyond the product. And I think that the stewards, the people who own those brands now, their jobs are to make sure that that legitimacy is maintained, and that emotional connection that the consumer has with the brand for whatever reason, who knows, the heart wants what the heart wants, is maintained. And I think that Hermes, for example, does a great job in preserving that. I think that Chanel does a great job preserving that. And I think LVMH does a great job for the most part preserving that. And I think that's the difference between these three companies and almost all the other fashion or luxury companies, is that they're obsessed about preserving the longevity and the legitimacy of the brands that they operate. Now, if are they? I don't think they're fooling customers any more than a chef in a renowned restaurant that carries the name of the founder of the restaurant is fooling their clients because they're not the same guy. So Portuguese is dead. His restaurant still thrives. So I think it's a matter of consumer choice, and I don't think you can fault consumers for making their choices. It is what it is. And then it's a matter of finding the companies on the other side of that equation that are respectful of the legacy and that try to preserve the value and the legitimacy of the brands.
Yeah, no, I hear you, and there are valid arguments on both sides. I mean, Hermes is in a class of its own, and it's always upheld that kind of luxury, but not only luxury, it's the quality. The quality has never changed, and when you see an Hermes product, you know it's an Hermes product. It could have been from last year, 10 years ago, 50 years ago. It's going to have that Hermes style.
Yeah.
But some of the others that as I say, the Kering we spoke about already. Balenciaga used to make these beautiful dresses which actually were handed down through generations. There are stories of granddaughters who have worn the same dress that their grandmother wore because it was so well made. And but now they've got Balenciaga's name on these plastic beach shoes. It's kind of crazy. And so I'm flipping to so I don't think you can compare Kering with Hermes. I think they're quite different. I think Kering is trying to milk brands. That's all it does. Whereas Hermes is true to its heritage. And then
exactly.
In the middle, you've got Louis Vuitton. I don't know. I know you're a shareholder. I don't know what you think. I mean, they seem to be shifting from the heritage Hermes style to the kind of hype driven, kind of caring style. Just think about Pharrell Williams at Louis Vuitton. He's a musician turned fashion designer who's changed the image of Louis Vuitton, particularly on the fashion side, to reach a different consumer market. And I'm wondering, what do you think that tells us as investors? Is this a turning point for the industry?
No, I don't think it's a turning point for the industry. I think it is the fact that wealth is changing hands, and different people have different preferences, and 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 the brands have to find ways to balance the legitimacy and the heritage with delivering what the consumer wants, right? I think you're absolutely right when in your comparison between MS and Kering. And I think Kering maybe missed an opportunity to revive Balenciaga with the same kind of product and care and quality that the original founder had, and they decided to go in a different direction. I think that's a perfect example of overdoing it. If you think about LVMH, for example, Louis Vuitton itself it started as a travel luggage manufacturer. They very high quality product, but it wasn't. They were not designing haute couture, right? And I think they kept pretty faithful to that heritage with the quality of the product. But it's a different world. It's a global world. Rich people want to be recognized and identified through codes, and they all want to look the same, and they all want to have the same experience. And it's up to these brands to cater to them without losing the scarcity value of the brands that they manage.
That's fair enough. While we're speaking about LVMH, as an investor yourself, I guess that Bernard Arnault features very heavily in your kind of reckoning and your value of the company. But his children now hold senior roles in the business, which kind of reminds me of when Bruno Cucinelli once told his daughter. He said you may inherit the business someday, but not necessarily the ability to run it. So, how do you think about succession and nepotism in these kind of situations? Of the 8 billion people in the world, I mean, just look at the way Buffett runs Berkshire. He hasn't handed the company down to his children. He's handed it over or brought in people who are the best placed to take it forward for the kind of next generation. Bernard Arnault seems to have gone the opposite way and try to keep it in the family. So just wondering how you think about that in terms of evaluating it as an investment.
Yeah, well, first, I'm not so sure that handing it down to the family is necessarily a bad thing. That's what Hermes and Chanel have been doing for the past 100 years, and it's worked incredibly well for them. So it depends a little bit on, I think it depends a little bit on how your kids are raised and what are the attributes that you would view on them as you're raising them. So I think it's too soon to say. It is a risk that needs to be considered in this transition that we're definitely very keen to observe. But there are a number of instances of family-owned companies that have been handed down from generation to generation that have done incredibly well, particularly in an industry where preserving that legacy is so important, right? So if you think about the privately owned watch companies, families are still heavily involved, right? Mm-hmm. So I think you can make both cases. It should not be taken for granted that a son or a daughter should take over the business. But it shouldn't be dismissed neither. I think there are merits to that path as well.
But shouldn't the CEO be doing what's best for the company and its shareholders, and by putting the family first? I mean, listen, if there was an open round of interviews and various people were being considered, and it turned out that of all those people being considered, without any form of discrimination, the son or the daughter of the founder was the best candidate, then fine. But without considering other candidates and simply putting your child forward, then are you not putting yourself and your family before the interests of the company and its shareholders, which is almost a breach of that fiduciary duty you have?
But what if the interest of the family and the shareholders is one and the same? They're there to preserve their wealth. They have all their wealth invested in the company. So it is by far the biggest source of wealth. It's not like they control the company with a super voting share that gives them very little economic exposure, but lots of power. They own 40 something percent of the business. Mm-hmm. So the preservation of that wealth is the number one priority for all of them. And I think that that is a key. There is a key component to be taken into consideration when you're making that judgment. And the second thing is, I don't expect LVMH to be managed exclusively by the family. Arnault himself has populated the company with very strong executives and a very strong culture that extends well beyond his own views of the business. And I don't think that's going to change. I view the family more as stewards of the culture than as executives who are going to make decisions that may damage the business. On the contrary, I worry about having a professional executive running the company who may be too focused on maximizing his stock options and sacrifice the long term of the business to the benefit of the short term.
Yeah, no, listen, that makes sense. So, I guess history is littered with stories on both sides. I mean, the Hilton family, I think they did very well. The business was handed down, Conrad Hilton, and I think the son achieved more than the father. But
Yeah.
then you've got on the flip side, I don't know if you know, I can't remember the name of them, but the chap that set up Dunkin' Donuts. He came from a very humble background. He didn't have enough money to go through university. Set up Dunkin' Donuts from almost a little van into a global empire. And with the money that he made, he sent his son to Harvard, the best business school. He came out with an MBA, and he handed the business to the son. And the son wasn't the right person, and drove the business into the ground. And in the end, the father looked back and thought to himself, I would much rather have given the ownership of the asset to my son, but the management of the asset to someone else. And that's the way I ought to have done it. So yeah, I guess there are lessons both
Yeah,
ways.
and I don't know if you're familiar with a company in the U.S. called Cintas
Yes,
Corporation.
yeah, Farmer, right?
Great,
Richard Farmer.
yeah, great example of a company that was started and during the Great Depression. The same family still owns the company, still controls the company, still runs the company, and they've done it brilliantly for I think now 3, maybe 4 generations.
Mm.
And I think that maybe the Dunkin' Donuts founder should have focused more on imbuing the son with the right values instead of necessarily sending him to Harvard.
Yeah, yeah. Okay. Going back to something you said earlier, you said that you look for founder mindsets in companies that you invest. One of your holdings is Tempur Sealy, the mattress people. And in the last decade, they've cycled through 3 CEOs, I think. Now, for me, I always see turnover and churn at the top of a company as a bit of a red flag, because every time management changes, you're effectively, as an investor, rolling the dice. You don't know what you're going to get, how it's going to work out. And I'd much rather have a long-term founder, same as you. So how do you think about investing in these companies with frequent leadership changes, given that you are
Mhm.
invested in Tempur Sealy?
I would make one small correction. Tempur has had the same CEO, Scott Thompson, for about 10 years now. He
Oh,
joined the company in 2015 and he's been there since then. He came from outside. He came as a result of an activist that got involved with the company and brought him in to run the business. That's when we got involved. That's when we met Scott and we found him to be an incredible executive who had the right mindset and seemed to have the right incentives in place. And in fact, he stewarded the company through an incredibly difficult period between 2016 and 2018 when they had a major disruption with their main retailer, the main distributor, Mattress Firm, which they subsequently acquired out of bankruptcy. And Scott is still there running the company. He owns a significant part of his net worth in the business. So I think he went from being an executive to being proper owner of the business.
right.
So we very much care about that. And we definitely detest high turnover at every level of the company. We don't like companies that are managed predominantly by boards, where you have people that have very little skin on the game. We like companies that have the right culture and the right alignment of interest.
Yeah, yeah, that makes sense. Okay, moving on. Just looking at Zeno, your firm, and it was a spin out from Dynamo, and your LPs, your investors, as I understand it, came with you from Dynamo. And but while that must have been great to have a ready-made investor base, perhaps it also limited your ability to introduce changes for fear of losing those investors. So what I'm wondering is how has your philosophy changed since launching Zeno?
I don't think my philosophy has changed since launching Zeno. I think the reason I launched Zeno is because my philosophy over time changed and evolved. I think it's the other way around. And in the early days of my investing career, and for a good part of it, I was a quintessential 10-gram focused value investor who was looking for cigar butts, and where the valuation mattered much more than the quality of the business. And I've been through this evolution in my career where more and more it became clear that quality trumps valuation, particularly when you have a very long-term orientation. So I think my decision to sell my ownership in the firm that I helped to start in Brazil and start Zeno was a function of wanting to have more freedom to implement my very particular view of how my capital should be invested. And that wasn't necessarily perfectly aligned with my former partners, who are very relevant investors in my fund, to whom I'm very, very close, and to whom honestly I owe everything. Because without them and without their guidance and without their support, I would never have arrived where I am now. But it was just time to sort of create my own vision and manage my own money exactly the way that I wanted it to be managed. So And to answer your question specifically, I was lucky enough never to feel any pressure from investors. I think either because they believed in what I was doing or because they thought that it wouldn't matter. I would be doing exactly what I'm doing now if I didn't manage anybody's money. And fortunately, I have a small group of investors that are very aligned with how I think.
Yeah, I think most investors go through that same journey. They start off on a kind of a Ben Graham cigar butt style, always looking for value, always looking for something cheap. And I think maybe the reason is because most investors start off looking very short term. They're looking to make a quick buck, and cigar butts perhaps are a great way to do it. But over time, I think very few people understand that even if you pay a high price for an equity, I mean, if you think about it in terms of return on equity, um, that return on equity being generated by the business isn't necessarily the return you're going to have as an investor. The return that you're going to have is very much dependent on the multiple you pay to the book value. Because you're paying a high premium to book, then you're diluting down that return on equity in terms of your own earnings. But if you hold that investment for a long time, and it compounds, then effectively that compounded growth is at book value. And so the premium you paid gets diluted and diluted and diluted. And as long as the company remains a good company and remains producing a good return on equity, over time, your returns will tend towards that return on equity. And I think that was really the essence of what Charlie Munger instilled upon Warren Buffett. And I think that's what made him change as well from the Ben Graham model.
That's it. I think you described it perfectly.
Yeah. Okay. Dynamo, as far as I understand it, always favored robust companies with durable earnings and tended to avoid investing in tech innovation, which they believed may do well in the short term, but often lacked longevity. Thinking about your investments, you seem to be delving into tech. You've got a holding in, I think, Appfolio and Okta, which are both software as a service companies. Just wondering what led you to depart from the Dynamo approach in that regard.
I haven't really departed from it. I still feel exactly the same way. I think I just have a more nuanced view about those business models and how resilient they may or may not be. At the end of the day, what I want to avoid at any cost in any industry, wherever I invest, is competition. That's the thing that kills your return more than anything else. It's not inflation, it's not interest rates, it's not lack of GDP growth, it's nothing. It's competition is what kills your business. And the problem with technology is that for the most part, particularly very nascent technology, is that it's very hard to determine if the moats are durable. And I think that's still true for the vast majority of companies in technology. Every now and then, we may come across an exception. In vertical market software, for example, which is where Appfolio acts, I think you'll find a lot more durable business models because the barriers to entry, but the switching costs are there and the barriers to entry are there. But at the essence, that's what drives that aversion that we had in Dynamo to technology, and that I still have today, not specifically to technology, but to businesses where I cannot attribute a high probability that the moats are durable.
Right. So you look at vertical software in Mark Leonard style.
Yeah.
Yeah, no, that makes a lot of sense. They are certainly more durable. I mean, on that subject, you see companies with market dominance that are able to capture a large part of the profit generated in their industry, which in your words are as close as possible to an unregulated monopoly with growth. And you say that competition is the worst enemy of equity investors, which I interpret to mean that you avoid commoditized industries. Yet you've invested in Ryanair, an airline historically a poor industry for investors. I'm just wondering, what made you comfortable investing in such a commoditized industry? Was it the fact that Michael Ryan follows the Herb Kelleher Southwest Airlines playbook?
Yeah. Look, I'll take one step back and I'll get to Ryanair. The thing that sort of, if you think about competition is one aspect of a broader theme, which is dilution. Mm-hmm. What you want to do is invest in businesses and invest in assets or units or whatever that are not going to be diluted over time. So if you have a business that is incredibly dominant, but you have a management that issues 10% of the equity every year to compensate themselves, you're getting diluted anyway. If you have a business that may have a strong position, but they're not able to protect themselves from inflation, you're going to get diluted anyway. It's all dilution, right? So in the case of, so competition is one aspect of dilution that I think is particularly underappreciated many times, especially if you're taking a longer term view. The case of Ryanair, I think that what they have is extremely unique and scarce. And in an environment, in a business that is highly competitive. And honestly, I never thought I would invest in an airline in my life until I met Michael and I understood the Ryanair business model. Because what they do is incredibly hard to dilute, because no one else is able to offer a plane ride from Birmingham to Malaga at 60 euros and still make money doing it. So that position, no matter what's happening around the world, is extremely hard to dilute because they operate in a model that no one so far has been able to replicate. and they've reached a scale and a network effect that makes it almost impossible for somebody to replicate that business. So yes, there is short-term volatility. Oil prices go up, oil prices go down. That will hurt their profitability in the short term. Yes, every now and then a new airline pops up, like a Norwegian from a few years ago, and they kind of create some imbalances in the market. But throughout its history, they've been able, I think right now in 20 years, I think they lost money 1 year, which was 2020. And they've been able to grow high single, low double digits their revenues. They've been able to grow their profits faster than that throughout the last 15, 17 years. So I think that in an industry where, for the most part, there's nothing that you would want to own, he built himself a position that is extremely hard to dilute, and that the market doesn't really recognize it and doesn't really price it accordingly.
Yeah. Okay. Makes sense. Something that really stood out for me when reading your most recent investor letter, you state emphatically that you won't spend any time discussing your fund's performance for any given year because 1 year is too short a period of time to arrive at any meaningful conclusion. And that reminds me very much of an anecdote told by Howard Marks about the manager of the General Mills pension fund. I don't know if you're familiar with it, but this guy was the fund manager of General Mills pension fund for 14 years, and the fund's performance consistently fell within the second quartile. He never exceeded the 27th percentile or never dropped below the 47th. Yet, measured over the entire 14-year period, he ranked fourth. And the moral of the story is that those chasing continual short-term outperformance ultimately hit the rocks at some point, and that impacts their long-term performance. And that seems to me to be very much your mindset and the way you go about things, which makes a whole lot of sense to me. But how has that message landed with your LPs and investors who typically expect to see constant alpha?
Yeah, it reminds me of a passage in a book that I read recently that states that average performance earned over a very, very, very long period of time is much better than outperformance over a short period of time. And the human brain is not really wired to understand compounding. So very few people are wired to see that and understand that. Look, I'm sure I have missed the opportunity to raise a lot of money for my fund over the years because I would not deviate from what I think is the right way to invest my own money. It's been an incredibly unpopular investment style for the last 15 years, where momentum was pretty much the only thing that mattered, and we lived in a world that was over financialized with all kinds of gimmicks and financial wizardry. That many times made me look obsolete or antiquated. But it's what I know it's what I know. It's what I like to do. And there are people who are willing to invest with me to help me do it. That's great. If not, it's fine as well. We can have a beer.
Yeah, that's fair enough. Did you suffer drawdowns during that period, or did people stuck with you throughout?
There were periods where there was drawdowns, yes, for sure. But like I said before, we were blessed with having found a very, very sticky investor base that has stuck with us for a long period of time.
That's great. Given your long-term approach, why stick with the partnership model? Did you ever consider Buffett's shift to a corporate structure?
Yes, I have, and I might evolve in that direction eventually. To be honest, I haven't had the time to think too much about it, and so far the fund model hasn't really created any nuisances for us. But that's a fair point, and it's how I already manage it anyway. So we might as well consider moving in that direction formally.
Yeah, it gives you more access to permanent capital. You don't have to worry about those drawdowns.
Yep.
Okay. I don't know if you're aware of this, but in the 1950s, the average holding period for a stock was about 8 years. Now it's less than 6 months.
Yep.
Which explains why short-termism drives Wall Street. And this then creates an unwelcome tension between most CEOs trying to appease Wall Street by prioritizing quarterly targets, often at the expense of long-term performance. Having served on several company boards, as I know you have, what did you learn about this tension from kind of being on the inside?
First, that it is totally unnecessary and disruptive, and it demonstrates how poorly built the incentive structure for executives, particularly in the United States, is. So I think that the U.S. market in particular, but not only, has been dominated by incentive structures that almost inevitably lead most CEOs to worry about the quarter and worry about the share price in the short term. And And that ends up creating these situations where decisions are made focused on the short term as opposed to the long term, which is exactly what we try to avoid when we're picking companies to invest in. But it's very pervasive, and I don't think that boards in the U.S. are well equipped or incentivized to deal with that problem.
Yeah, it's interesting. You know, we spoke earlier about founders' mindset, and one of the things I've learned over the many years that I've been investing is that most businesses are not run by business people. And you know what I mean by that is that you could be a software engineer and you could write a fantastic app which goes viral, and you decide to build on that success and you raise some capital and you employ some people and then you build some more apps, and all of a sudden, you know, you may have raised that capital through the equity market, in which case you've got a public company and you're the CEO, but you're still a software developer. Right? You don't know anything about business administration. You're not really equipped with the expertise or the skill set. And you know, I found that in all sorts of industries, that's very much the case. You know, people are running companies that perhaps shouldn't be running companies. Is that your experience as well?
Yes, not necessarily for that reason specifically that you described, but yes. I think that the problem is when a company goes from insurgent to incumbent, lots of things happen in the way that the company is managed that is detrimental to the long term development of an ownership culture. And the challenge is that for the insurgent phase of a company, you need a certain type of skill, and for the incumbent phase of the company, you need another type of skill. What doesn't change is while the skill sets may be different, the culture should be the same. And that's why a company like Amazon is so impressive, because the skill set that was necessary when they were selling books online is completely different from the skill set that they have now, but the culture has remained exactly the same. And that's the type of situation that we're looking for. I think you'll find it in companies like Ryanair, you'll find it in companies like Costco, you'll find it in companies like LV, you'll find it in a few companies. But that's the holy grail. That's what you're looking for. As Andy Jassy puts it, is that you want the company to be run like a startup.
Yeah. You know, I tend to find that when I engage with some of the C-suite executives, I introduce constructive challenges to all sorts, you know, capital allocation in particular, whether it's, you know, dividend policy, share buybacks, stock-based compensation, whatever it might be. And generally, I try and frame questions using anecdotes and using stories. I mean, there was the one time I remember referring to the guy that founded the Harman Kardon hi-fi business. And he sold the business for 100 million, I think back in the 70s. And the people that bought it from him didn't do a great job. And a couple of years later, he managed to buy it back for 50 million. So, you know, if you could have that kind of luck, cashing in 50 million and getting back what you started with. But, you know, I tell this story, and you know, the response from the CEO might be, wow, you know, that was a fortunate situation. And then I say to him, well, you know, do you realize you went public at price X and your stock's now trading below price X, well below intrinsic value? You're effectively got the same opportunity, but even better opportunity, because being a public company, you can buy these shares through the market. And you know, they take a pause and they take a breath, and you know, actually never seen it like that, never thought of it like that. And another challenge I might raise is, you know, there are two ways in which a business can raise capital, either through the equity market or through the debt market. And most companies are quite keen to pay down their debt as soon as they can, but very few companies think about paying down the equity. And it just doesn't make any sense to me when equity is the most expensive form of capital. And you know, you introduce these challenges, and all of a sudden the penny drops, and people see the light. And I've had these conversations time and time and time again. And it actually led me to write a book to capture all these anecdotes and these stories. And chapter by chapter, I deal with each different topic thematically. And what I tend to do now is if I'm invested in a company and I think that they can improve in a particular way, I'll send them a copy of the book. So, you know, you might want to read chapter 12, you might want to read chapter 15. And it's actually led to some significant changes. Anyway, all that to say, you know, just out of curiosity, how do you encourage CEOs to change their mindset when you think that they could be doing something differently?
Well, before trying to encourage the CEO to do something, first I have to believe that he is naturally inclined to behave that way, because I don't think in the vast majority of the cases, I'm not going to be able to change their behavior if their incentives are not there, right? So most CEOs are incentivized not to build long-term equity value, but to maximize the short-term performance of the share price. And sometimes it's better to do bad acquisitions that will drive the short-term performance of the share, instead of buying back its own stock that will probably have no impact on your share price in the short term, but that will have huge impact on the long term. So first thing is I want to try to understand the incentives and the cultural aspects of the business. And the truth is, if those are the right ones, it's not going to be very hard to convince the person to buy back shares or to act appropriately with regards to capital allocation. So we spent a lot of time trying to diagnose if that's the mindset, if that's the culture, and unfortunately, most of the time it isn't.
You sound like the Brazilian Charlie Munger. Show me the incentives and I'll tell you the outcome, right?
Yeah.
Exactly right. You've also said that investors focus too much on what the market thinks about the stock and too little on what customers, suppliers, employees, and competitors think about the underlying business. Just wondering, how do you gather those kind of insights given modern day confidentiality and data restrictions?
Yeah, we try to talk to as many people as we can who are not necessarily in the company, but that work with the company. And we're not trying to gather specific data about the business. It's more about understanding the behavior. So what we really try to do most of the time is identify patterns of behavior of the business, which we can identify by talking to people that interact with the business on a recurring basis. So usually it's by focusing on that kind of thing that we're able to draw a picture of what the culture of the business is really like.
And did you find people are very open to speaking to you? I mean, there's nothing in it for them. They get a phone call from you, you're an investor, you want to take a stake in another company, not their company. They might be a supplier, they might be a customer. They're always happy to give you their time.
Yeah. For the most part, people are pretty open to talk if they think it's a productive conversation. I mean, I remember when we were starting in Brazil in the early 90s. I mean, this is pre-internet, and companies in Brazil didn't have investor relation departments or anything like that. You would call the company to ask about the numbers. They would give you the phone number of the accountant. There was nothing like financial statements were published in the newspapers and you have to wait until they were available. So what we did back then to start to be able to have a conversation with these companies is we started showing up at shareholders meetings,
right?
Which nobody else did, but because we had bought shares, we had the right to be there. And when we got there, first of all, people wouldn't let us into the meeting, and then we had to explain that we were shareholders, show the share certificate, and show the law that we could be there. But once we got in and we started interacting with the management team, what we found is that they were very eager to talk and they were very eager to engage and answer questions. And I think humans in general like to converse and like to exchange ideas. Thankfully, so in our experience, it's not that difficult to find people that are willing to talk and discuss. It's takes some time. You have to be patient. You have to know how to talk to them. But yeah, for the most part, it works.
Yeah. Okay. You narrowed thousands of companies available to invest in, public companies, to a short list of about 70, with only a few making it into the portfolio. So I'm wondering, what separates the good that makes the watch list from the extraordinary that makes the portfolio? And how often does your watch list change?
What separates one from the other is two things. First is our ability to attribute a high probability that whatever success they have achieved in the past will be achieved in the future. So we have to be able to determine that, this is possible and highly probable. And second, it's when we identify that there's a true founder's mindset in those companies. So those are the two things. And what was the second part of your question?
Well, I was just wondering how often you
how often
reassess the watch list. Yeah.
Yeah, the watch list doesn't really change very often, and it shouldn't, because if these companies are remarkable, then the churn should be small. But we reassess it every quarter. But if you go back, and we did a lot of sort of back testing going back 20, 30 years, and it changes remarkably little.
Well, I guess if you're investing on a qualitative basis, quality is either there or it's not, right?
Yeah.
In terms of quantitative investing on a short-term basis, anyway, the numbers can flip up and down. So, I mean, given your concentrated portfolio, I'm guessing that adding something new usually means something else has to go. And as your hurdle rate rises over time, I guess the amount of churn diminishes. It kind of reminds me actually of Nick Sleep when he ran the Nomad Fund. I think he was really heavily invested in Berkshire Hathaway, Amazon, and Costco.
Yeah.
And I think he once said that he never found a fourth company which was good enough to reallocate capital from the other three. So, as your hurdle rate rises and your portfolio is heading towards optimization, do you find that there are certain sectors that consistently are favorable and others which should be avoided? I know we discussed airlines earlier, and a lot of people avoid airlines. Obviously, you haven't. You've explained why you haven't. But generally, how do you think about it on a sectoral basis?
Yeah, I think first of all, I think Nick Sleep and Nomad are huge influence on me. I've read everything that he's written, and I hugely admire the way that he thinks and writes and obviously the success he's achieved. Uh, and interestingly enough, I find myself with a portfolio that is over time becoming more and more concentrated as well, as I own more and more of fewer companies. I don't think I can sort of frame it in terms of industries because we've found exceptional businesses in the most diverse industries. So, and then we found a lot of crappy businesses also in those same industries. So you can look at for example, as you may be aware, we own a very large position in a company called Linde, which used to be called Praxair, that bought Linde,
gas company,
German
right?
industrial gas company. And there are 3 industrial gas companies in the world today that have 90% of the market in the world. Linde is the only one I would own. And in aerospace, there are a number of companies as well. So far, I've only come across 2 that I would be willing to own. And so it's very hard to sort of frame it in terms of industries. It is really a company by company basis.
Yeah, yeah. No, the only reason I ask is because I was speaking to Terry Smith recently. I don't know if you know Terry,
Of course,
Funsmith, exactly. And he always said that, leopard never changes its spots, I think were the words he used. He said, some industries are better than others, and it will always be that way. And he's always favored consumer staples, for instance, and always disregarded other industries. But every investor is different, and obviously you don't see it that way.
Yeah, yeah. What I would say with regards to Terry's approach is that industries change more often than companies. So the consumer staples industry, for example, is much worse now than it was 20, 30 years ago, because there's been a number of changes around that industry that made it far more competitive than it used to be in the past. Some companies have excelled and have done incredibly well in that environment, but industries change more often than companies.
Interesting. Okay. What about cultural differences across regions? So, you've invested in various places, but, the US is very risk-taking in its mindset, whereas Europe is more conservative. Does that affect your investment choice?
There are differences in different geographies from a cultural point of view. I don't know if the right way to frame it is to think about one is more risk taker and the other one is more risk averse. I think that, and this is a generalization that isn't true across the board, but I think in the US you'll find more companies that have the kind of culture of innovation, of less hierarchy, and more dynamism that we like. There are fantastic companies in Europe, but in general, and this is a function of cultural things and of legal aspects even, companies are more inflexible in their structure and in their ability to adapt. And I think that, to your point, European society functions on the basis of the precautionary principle, while the U.S. economy functions more on the basis of an entrepreneurial approach to things.
No, absolutely. I mean,
I think that makes the difference.
Yeah, I mean, you've got to look at the law, the way the legal system's set up. So, for instance, in the US, look at the bankruptcy law. If you run into trouble, you can declare bankruptcy and then pretty much set up again, and off you go. And people will always chalk that down to experience and say, well, you're coming back a second time. You've learned something. You're better now than you were then. Whereas in Europe, you fail once, you never get a second chance, generally.
Yeah.
And there's also the fact that in the US, you've got all these big tech companies. They all seem to come out of the States. And even the tech companies that emerge in Europe tend to need US backing to thrive. I'm thinking of Stripe. I'm thinking of Spotify. They effectively needed backing from the US because they couldn't find it in Europe. But the other thing touches on something that we mentioned earlier, that in Europe, there seem to be a lot of family-run businesses. And particularly when the business is handed down across generations. So, it's no longer in the founder's hands. The founder may have passed away a time ago. So you end up with the business, or a large chunk of the equity in a family trust. And the beneficiaries of that trust are a large number of people within the family. And the trustees are really only concerned about one thing: preserving capital and the income that flows from that fund that can uphold the lifestyle of everybody within the family, feed all of those mouths. But meanwhile, if you're an external investor, you might be interested in growth. You're not going to see it because that's not the way the company's being run. It's being run for the benefit of the family, not for the external shareholders. I mean, I often wonder why they don't take these companies private. But I've seen a lot of European companies which look fantastic on paper, but effectively the family act as a drag on growth and on performance. So there are some key cultural issues, and I was just wondering, you've come from the Americas generally, from Brazil over to Europe, and I'm guessing things are very different here. But just wondered if you had a particular take on that.
I agree with everything you said. I think that's exactly right. I think the ownership structures in Europe many times will incentivize a behavior that is much more prone to complacency. And the ownership structures in the US will do the exact opposite. And this is part driven by law. This is in part driven by taxes. This is in part driven by culture. And it is very much my experience in Europe, where you find some remarkable businesses that have created incredible technology or dominant market positions that at one point, well before I would have expected them to mature, they've prematurely matured.
Mm-hmm.
Yeah.
Yeah. No, I understand. I mean, on the subject of different cultures, you're fluent in Portuguese, Spanish, French, and English. I'm just wondering, how has being multilingual given you a competitive edge as an investor?
Um, I think I don't really think it's given me an edge as an investor. I think it's given me the opportunity to interact with people and to get to know people in ways that if I was conversing with them in English only, it wouldn't allow me to really understand and capture the essence of that person. That in turn helps in identifying cultures and hence investable opportunities. But it's a nice to have, but it doesn't really I don't think it's made a massive difference for me as an investor. As an individual, I think the process of learning and having to keep the brain plasticity, or yeah, I think that's the word, necessary to learn and speak in different languages has been very helpful.
Right. Okay. Okay, moving on to kind of macro aspects. Over the past 15 years, and I think you alluded to this earlier, markets have been distorted by cheap and plentiful money supply, the rise of passive investing, social media driving all kinds of crazy behavior on the markets. I'm just wondering, can you speak more about what aspects of today's market concern you the most?
I think that the fact that, to which you have alluded already before, that everybody has become so short-term oriented, and that that the behavior that comes with that, I think, is one that overemphasizes the search for rewards without properly assessing the risks. And I think this was I think human beings have always behaved that way. If you look at sports betting and gambling, it's been a part of human life forever. It's just that what you've had over the course of the last 10 years, maybe, is that behavior has crossed over to financial markets, partly because technology has allowed for the gamification of investing. And look, from my point of view, from the way that I manage my money, it won't make any difference. But what I worry about is that a lot of people are going to get hurt when this wave recedes, and I feel sorry for them.
Yeah, I agree with that. In terms of short-termism, I don't necessarily see it as a problem for you and me. And why I say that is because it does throw open some fantastic opportunities. Well, I mean, wasn't it Charlie Munger who said that the markets transfer wealth from the impatient to the patient? Just recently, on the back of all the kind of Trump madness and the volatility in the markets. But not only that, some of the recent quarterly earnings of some companies, the market responds in the most ridiculous way, and you can pick up some incredible bargains if you've got a long-term mindset. You get a huge dislocation between price and intrinsic value, and for you and me, that's a great opportunity. So, although the market's not necessarily functioning efficiently, did you agree that's more of an opportunity than a hindrance?
I do. Yes, I do. Provided that it doesn't cross over a certain line that forces regulators to behave in a way that could be value destructive for the long term. But yeah, for the most part, I think you're right.
Yeah. Okay. I mean, you're particularly concerned about dilution. You mentioned it earlier. And for me, the most abused aspect of modern corporate finance is the egregious levels of stock-based compensation accompanied by repurchases aimed at offsetting dilution, normally well over intrinsic value, which destroys shareholder equity. I mean, the whole concept of sweat equity makes sense for a bootstrap startup, and it's where the concept originates. But today it's morphed into something entirely different. And contrary to popular opinion, it doesn't align insiders with external investors. In fact, it does the opposite. It enriches insiders at the expense of external shareholders. And I'm wondering, how do you think about stock-based compensation when it comes to assessing a company? I mean, you find a great company, for instance, with great technology and great people, but they've got this egregious stock-based compensation policy. Is that enough to put you off?
Yes, I wouldn't touch it with a 10 feet pole.
Yeah. Okay. You and me both. Okay, just kind of wrapping up, last few questions. I appreciate you've given me a lot of time for that. I'm thankful. So having spoken to you and read some of your writing, particularly your investor letters, I see elements of Howard Marks in your attitude towards risk and Warren Buffett in your investment style. Are there any other key people who have shaped the investor you are today? I mean, you mentioned Nick Sleep earlier.
Yeah,
Are there any others that you'd like to mention that other people should explore?
yeah. I mean, Nick Sleep for sure. The two guys that gave me the opportunity when I was 19 years old to start at Dynamo, Luis Orenstein and Bruno Rocha, are two remarkable individuals as both investors and just people from whom I've learned a lot. And they're definitely huge influences in my life. Uh, I Peter Lynch. Some things, I read his book, One Up on Wall Street, when I was very young, and that had a big impact on me. You mentioned Buffett, but obviously Munger, maybe even more so than Buffett,
Yeah,
has been an influence in my life. Uh,
I'm guessing Philip Fisher as well.
yeah,
Given,
Philip Fisher for sure. But I think I feel like I'm more Fisher has been more of an indirect influence on me through Munger and Buffett. But very much so. Uh, and Yeah, I think those are the guys that have really had sort of an impact on my view of the world as an investor and as
yeah.
an individual.
Peter Lynch is an interesting one. I mean, I love his writings, I love his books and the way he thinks and his logic. Although he never ran a concentrated portfolio. You know, at
Oh,
Magellan, I think he had over 100 positions at any one time.
yeah,
Um, but anyway, I mean,
yeah,
that was before passive investing, right? So I guess he had his own kind of passive style fund.
yeah,
Um,
yeah. That's a good point.
are there any particular books that you'd recommend people to read that you read, particularly those that are lesser known?
I don't think there are any books that are lesser known these days. Everybody knows everything. Look, two books that I read recently that I wish I had read them when I was much younger. One is called Mastery by Robert Greene. And the other one, and I'm not going to remember the name of the author, is called Range,
Okay.
which talks about sort of the benefits of having a broader education as opposed to being hyper focused on a few things, which has resonated tremendously with me and how I've tried to sort of educate my sons. Um, and But yeah, other than that, I mean, anybody who has the desire to do what we do, must reads are Nick Sleep letters and Buffett annual reports. Those are mandatory reading.
Yeah, yeah, and then also, shareholder letters from, well, you mentioned Buffett, but the Bezos letters are outstanding.
Yes.
Are there any other particular shareholder letters that stand out for you that are, I mean, Mark Leonard shareholder letters were always great.
Yeah, Mark Leonard is great. Costco.
Yeah.
Uh,
The early Jim Sinegal letters or
yeah,
later.
the early, all of them, but definitely the early Jim Sinegal letters. Uh, yeah, I think that comes to mind. There's not a lot. I mean, particularly over the course of the last 15, 20 years, annual reports have become sort of a bit sterile.
Yeah. Yeah, I don't disagree. Okay. I mean, to wrap up, I always like to ask investors about lessons learned through the course of their careers. And as I said to you earlier, for me, when I started out, I focused too much on businesses and too little on the people running them. And then I subsequently learned that most businesses are not run by people with the skill or aptitude for business administration, which can only ever lead to kind of suboptimal outcomes. So now I always focus on the people first. What do you know now that you wish you knew when you started out?
Uh, that too much information can actually hurt you in your decision making. And that this concept of avoidance of dilution in everything in your life is a very, very powerful one. And it translates to your personal relationships, to how you invest, to how you think about the world, is a value. Very few things in the world really hold up a lot of the value of the world. Understand that and focus on those things, and your life will become much easier, much simpler, and much richer.
Yeah, it's kind of the Charlie Munger framework, lattice work of mental models. I mean, he always spoke about compounding being one of the wonders of the world, but not only compounding of money, it's the compounding of knowledge and the compounding of everything. And what you speak about dilution is the opposite, right? As compounding can build things up, dilution obviously brings them back down again. But too few people focus on that side. Okay, that's wonderful. Cristiano, thank you very much for your time. It's been an hour and a half. You've been very generous with your time. Thank you very much.
Thank you very much for the opportunity, James. It was a pleasure.
Excellent. Have a good evening.
You too. Take care.
Bye-bye.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.